Most blown accounts don't start with a bad strategy. The financial destruction happens before the market even opens, triggered by a compromised mental state. Every morning, you make dozens of micro choices: what to wear, what to eat, how to manage your commute. Over time, these small actions drain your cognitive battery. By the time you look at the charts, you are already experiencing decision fatigue. If you bring an argument, a poor night's sleep, or work stress to your trading desk, your emotional stability is completely gone. You start clicking buttons impulsively, reacting to the market instead of analyzing it. The markets existed long before you arrived, and they will run every single day long after you leave. If your emotions are running hot, the single safest action you can take is to walk away and let that day go. Trading while emotionally unstable is an act of total surrender to the market. When a building is burning, an ordinary person runs away. A firefighter runs straight inside. The difference is that the firefighter possesses a distinct, predefined plan of action to handle the chaos. Look at this clean chart. 1 hour before the open, objectively draw your support and resistance zones. Using those zones, calculate your exact position size, precise stop loss, and target take profit. Every boundary is set before a single dollar is risked. A common trap is carrying the emotional weight of a past trade into this new setup. If you increase your risk because you won yesterday, or reduce it out of fear because you lost, your technical parameters are immediately compromised. Entering the market without this rigid framework transforms a trader into a gambler. Once you click buy, the environment shifts. You feel intense physiological tension, a spike of panic when the candles flash red, and a surge of overexcitement when they push into the green. These sharp emotional swings are diagnostic tools. If a routine fluctuation in price causes your heart rate to spike, it is a clear physiological symptom that your position size is far too large for your account. That tension multiplies when unexpected news hits the wire. A sudden earnings report or an economic data release instantly injects extreme volatility and information overload into the market, triggering immediate panic for unprepared traders. If you are gripped by fear while holding an active position, your preparation has already failed, entirely regardless of what the actual price is doing. This chart shows the mechanical safety net in action. The moment price action hits a 1-to-1 risk-to-reward ratio, you snap the stop loss to your break-even point. If the market stalls and anxiety creeps in, you deploy the 50% rule. You immediately cut the position in half, locking in partial profits. Closing the entire trade out of sheer panic is a mistake. Leaving half your position active forces you to stay psychologically engaged, ensuring you actually observe and learn from how the market structure plays out. Mid-trade execution requires zero improvisation. Success in the live market relies strictly on triggering pre-programmed defensive mechanics. The second you close a position, a new psychological wave hits. You suffer the instant regret of taking profits too early, or the sharp anger of watching your stop loss get taken out. This specific post-trade window is the most dangerous period of the day. Driven by that frustration, traders often force a new, unplanned entry to win the money back, destroying their accounts through revenge trading. Your only responsibility after a trade is to review a physical checklist. You systematically tick off your strategy requirements to verify you follow Jerome rules, actively ignoring the actual financial outcome of the trade. Judging the quality of a trade solely by its profit is a beginner's trap. Professionals measure their success by their strict adherence to this system. To prevent emotional spiraling, you have to establish hard boundaries. This means strictly limiting yourself to 1 or 2 trades within a defined geographical window, like the London trading session. You must adopt the mindset of a professional athlete. Once a match ends, the outcome is a closed chapter. You review the tape, state, "We will do better next game," and you move forward. If you breach your daily loss limit, you deploy the ultimate failsafe. You physically shut the laptop, or you completely delete the trading app from your phone for the rest of the day. Consistent long-term profits rely on the mechanical discipline to shut the machine down when the human mind fails.